Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Today I want to go over an article released by the Bank of Canada about a week ago that goes over their willingness to overshoot their inflation mandate. So what that means is the Bank of Canada allowing inflation to go much higher than its mandate of keeping a between 1 and 3% inflation rate, usually in reality around 2%. This article goes over their willingness or almost even intention of having inflation shoot well above the 2 or 3% mark. Given everything in the media lately, we seem to think it seems to look as though inflation is the devil and will be the undoing of the entire world. But this article actually seems to argue that inflation would be good, at least in the short term, and that the Bank of Canada intends to let it run hot, and let it go up to 3, 4, 5%. And it may be even higher in the future depending on the circumstances. So today I want to talk about why the Bank of Canada thinks it needs to increase inflation, why the bank is limited in its options to increase inflation, why it thinks higher inflation will lead to higher economic growth, and whether or not the policies it's looking at actually reflect that of negative interest rates, in effect, if not in name. We've heard so much about negative interest rates in the previous years, and we've seen it both in the Bank of Japan and a few other central banks have some experience with negative interest rates to varying degrees of effectiveness. But we've never really had it in the West. We've never had it in the US or Canada. So if we're going to negative interest rate territory, I think it's good to have a discussion about it as the bank seems to be favoring ideas that do move us into that kind of territory. And then I want to finally go over whether or not the bank is sort of moving closer to a US style Federal Reserve type of governance rather than sort of the limited mandate that they've traditionally had here in Canada, and kind of talk about sort of some of the implications of a move towards more of the Federal Reserve type of governance. So the article suggests that we need inflation as a means to help everybody in the economy. It's generally accepted that the lower income bracket got hit the worst from the shutdowns and the lockdowns, and we're also the slowest to rebound economically once everything started to open up. There's been quite a few articles out there showing that while the higher income earners have generally regained everything that they lost job and employment-wise during the pandemic, lower income earners are still at 20% less than they were earning before the pandemic started. So what the bank is suggesting here is that by allowing inflation to run hot, that we'll be able to regain full employment for everybody in the country, not just the higher wage earners that we might see when we only see inflation around 2%. The article comes to this conclusion by looking at a number of studies which show that higher inflation does lead to higher growth for the lower economic sphere in society. So it does this through a number of ways. Higher inflation usually can lead to higher savings, which allow lower income groups to have at least an insurance fund behind them. Higher inflation also leads to more jobs available, and the increased savings allow people to have more choice of a job that would be better for them, a job that's better suited to their skills and their niches. So the idea is that by allowing inflation to run higher, the lower income bracket will have a higher amount of choices, and that will in turn help with the overall economic recovery of the entire country, and not just those higher wage earners that are already doing fine and actually did quite well during the pandemic. Finally, the idea with letting inflation run hot is that it avoids the risk if we were to raise interest rates too fast and not let the economic recovery fully bloom for everybody, where everybody recovers. If we raise rates too fast and there's a slowdown in our economic recovery, then it's likely that those who are already somewhat disenchanted, those who are still unemployed from the lockdown, might give up entirely on getting a job, and then we'll have even more of an issue with the lower income groups not being able to recover from the pandemic. So there's a very real risk of moving too fast in tamping down inflation, and that will actually hurt more than help our overall economic recovery. So that's great. The Bank of Canada is sort of shifting its mandate, which we'll get into, but they're shifting. They want to see the inflation run hot. They want to see inflation of 3, 4, 5%. Well, we've been trying to avoid inflation for the last 50 years. You would think we'd know how to induce it, and we do. Usually, it's by lowering interest rates. The problem is that when COVID started, the Bank of Canada lowered interest rates so low, down to what they call effective lower bound, or ELB, which means that they can't go any lower without moving into negative interest rates. And negative interest rates are a completely different shift in policy, closer to that of the Bank of Japan. That's never actually been tried in the West. It's never been tried in the US, and it's never been tried in Canada. What negative interest rates effectively do are charge you for having your money in the bank. The idea is if you're being charged to have your money in the bank, that you're going to go out and spend it. You're more likely to spend, buy goods, buy services, put your money into the economy rather than holding your money. Basically, if a higher interest rate induces you to save because you're going to make money from doing so, then a negative interest rate induces you to spend. So that's a way to get money out into the economy, which is what the Bank of Canada did when it lowered interest rates. It made it so cheap to borrow. The idea was that you'll borrow money and you'll go spend it, and that'll help spur economic growth as much as we could during the lockdowns. But rates are so low right now. Any inflation that we have right now just came out this week actually at 3.1%, well below the bank's expectations. But any inflation that we have right now, we can't get lower interest rates than the 0.25 policy rate currently set by the Bank of Canada without going to those negative rates. And negative rates have a whole host of other problems, which we're not going to get into in this video. There's plenty of videos out there about them. But the bank wants to avoid moving into that area of negative interest rates. There's once you're in them, it's very difficult to get out them and get out of them. And as we're seeing, with even being so close to 0% as it is, it's really constraining our policy choices. And this leads to why the bank wants to see higher inflation, because to a certain extent, that actually is effectively negative interest rates. To understand why we're actually getting into negative interest rates by this policy by the bank, if the Bank of Canada continues to overshoot inflation, it's written right in the article here. The bank can also induce a greater decline in the real interest rate and thereby stabilize the economy faster than by returning inflation directly to its target. So what they're talking about is the real interest rate, which is the difference between the money that's paid on interest on all the money that's lent out and the inflation rate. So let's say I lend you $10 and inflation is 20% and I've lent it to you at 10%. So in a year from now, you will pay me back $11, but that $11 won't buy what that $10 used to. That $10 would now take $12 to buy that because inflation has run up to $12. So I've lost money lending it out to you. But I've lost less money lending it out to you than I would have had I have hoarded it. Had I just kept my $10, it would now cost me $12 to buy the same amount of goods. Instead, I have $11. So of course, I'm going to try to lend out my money because I need to recover as much as I can out of that inflation rate, right? Because it's because I want to at least get close to that $12. So I'm being penalized for holding on to my money. If I'm going to be penalized for holding on to it, I'm going to lend it out. And there we have negative interest rates. That's exactly what the Bank of Canada is talking about here. Because they can't lower actual interest rates, they can't lower the policy rate without going negative. What they're doing is effectively lowering real interest rates, the difference between inflation and the rate at which the money's being lent out, and which will further induce people to spend. I would rather buy that TV this year knowing that it's only $1,000 when next year it's going to be $1,050 or $1,100. It's a means of, same as they've been doing all along this whole time, it's a means of getting money out into the economy. Get more money out into the economy, get people to spend, more jobs, higher inflation equals more jobs, helps lift everybody out. not just the more well-off, but the lower income strata as well. So that's their idea for why they want inflation to run higher. Not only does it, because it allows them to lower interest rates, go into negative rate territory without actually saying it, and it helps gain employment for everybody, to get everybody out of the economic downturn that was the pandemic. But is this the Bank of Canada's mandate? It's not. The Bank of Canada's mandate primarily is to control inflation. They're not supposed to be concerned with employment. That is left to the government, our elected representatives. The Bank of Canada, if they do engage in more of a policy of actively trying to overshoot inflation, not just allow it, but actively engage in trying to overshoot it, make it go to that 3, 4, 5% range. If they actively engage in that, they're acting much more like the Federal Reserve in the United States, which has a dual mandate of full employment and keeping inflation in check. Whereas the Bank of Canada right now only has a single mandate of keeping inflation right around that 1 to 3% range. So, what this would be, this is an extraordinary step if the Bank of Canada takes it and actively trying to see inflation rise. Now, why does this all matter? Well, it matters because when we're watching what the Bank of Canada is doing and trying to gauge our interest rates and our mortgage rates in the future, well, if we think we better lock in right now because inflation's going to hit 4% and the Bank of Canada is going to bring the hammer down, if this is their policy, then no, that's not going to happen. Or that's not likely to happen, since they do want to see inflation go up and up and up. Because the idea is that it will help the economy in the short term. So it does matter for us how they're going to react to the inflation data that comes out. And it will better allow us, no one can predict interest rates obviously, but it will better allow us be better armed with more information as to what is going to happen when we do see those inflation figures come out. I did a video on this yesterday where I said that the bank was most likely very surprised to see inflation only at 3.1% because they're expecting inflation to go higher. That, as we've talked about, is effectively them using negative real interest rates to help spur economic growth, since they can't actually move down to negative rates, as that would signal a massive policy shift, much more like the Bank of Japan, rather than anything we've ever seen here before in the West. Surely there will be more articles out as the situation progresses, and as more inflation data comes out. That was a big surprise yesterday, with the inflation rate coming out as so low. So as the economy still continues to rebound, or they continue to try to help it rebound, we'll have more videos out like this that look at mortgage rates, the Bank of Canada rate, and what they're doing more and more. If they're moving more and more close to that negative interest rate territory. If you like this video, click like and subscribe and you'll get those updates. And thanks so much for watching.